I'm a 22-year-old stock market investor and I'm currently up £20,000 from the last 3 years of investing. And in today's video, I'm going to be sharing all the basic information that you should know before you start investing as well. I have absolutely zero finance background and obviously started at quite a young age, so if I can do this, you most definitely can too. For those who don't know me, hello, my name is Gabriella, I'm 22 and currently have a net worth of over £100,000. And I post daily on my short form content and weekly on my YouTube, so if you'd love to follow along and learn more, then I would love to have you here. So let's get started. To help bring a bit of context to all of this, I'm going to start off with what actually is investing. So investing is a very broad term. It's not just specific to the stock market, but in essence, it is the process of putting your money into an asset such as a house, watches, even designer handbags, because you believe the value of that asset will go up and you can eventually sell it on for a profit. As I said, you can literally invest in anything. There are so many different kinds of investors in the world. For today's video and looking at my speciality, we're going to be discussing investing in the stock market. By the way, I'm so ill right now, so I apologize in advance. So it might be helpful to actually explain what the stock market is. So the stock market is very similar to a fruit market, but instead of going there to buy fruit, you're going there to buy and sell shares of companies. When you buy a share, also known as a stock, those two words are basically interchangeable, you're buying a very small piece of a company. If that company grows and becomes more valuable, your shares will rise in price. Whereas if the company struggles, those shares can lose value. Let's look at an example situation to help you visualize this a bit better. So let's compare a stock or a share in a company to a slice of pie. So the pie represents a company, and let's say each slice of the pie represents a share in that company. Let's say you bought one of those slices of pie for £100. Then the stock rises by 10%, bringing your total value of that slice to £110. If you decide to sell that, you would have made a £10 profit. If you don't decide to sell that slice of pie, then it would have gone up £10 of value on paper, with the potential for this value to keep going up. I wish I could say stocks only go up and you only ever make money, but there is also the possibility that these stock prices do go down as well. So again, let's say you bought a slice of pie for £100, but the value of that slice went down by 10%, meaning that your slice or share in that pie is now only worth £90. If you decide to sell it, you would have made a loss of £10, but again, if you don't decide to sell it, it's only a loss on paper. The value of that pie could still go up or it could keep going down. Now, a part where a lot of people seem to get confused is what actually causes the stock market to go up or down. The first reason could be a change in supply and demand of the shares in a company. If more people want to buy a stock than sell it, then the price usually rises. But if more people want to sell than buy that stock, then the price will probably go down. What changes to supply and demand could be a various amount of things. For example, it could be news about the company. Let's say that they've made a really good amount of profit in the last quarter. Investors may become more confident and more optimistic about the company and may want to buy shares because they see potential for those shares to keep rising in value. For example, where a company's stock price might have gone up massively after reporting strong earnings. There's a video in 2025 where the stock price went up by 24% after their reports. But as I said, as much as prices can go up because of good news, prices can go down because of bad news, such as Meta prices plunging by 24% after they reported poor earnings one quarter. The next reason stock prices could go up or down is because of the national or world economy. If the economy is growing, people usually buy more, businesses make more profit, and therefore people want to invest in these companies more and prices rise. But during a recession or high periods of inflation, consumers usually spend less, profits can drop, and also share prices usually follow that. Am I just dropping this everywhere? I spilled coffee all over this. No! Third reason why prices may change is because of big movements in the market from big sharks. The big sharks are also large investors in the stock market, such as hedge funds, billionaires, banks, can single-handedly change stock prices just because they invest so much money into the market. So these big sharks either buying or selling a stock can massively change the prices. A lot of the big-time investors also publicly share what they're invested in. So if hundreds or even thousands of people are watching these, they can also follow those movements and again massively change the price. The next reason is future company expectations. A common misconception for beginners is thinking that the stock market prices reflect how people are currently feeling about certain companies, which can confuse people because some companies report losses on their earnings, but actually their stock prices go up. That's not because people think their company is currently performing well, it's because they still have the expectation that the company will perform well in the future. So if news comes out that there's a potential merger of two certain companies, even if one of those companies currently isn't performing that well, their stock price might massively increase because people see potential in that merger. Another example is where potentially there was a new CEO managing the company. If investors have a lot of confidence for this new CEO, stock market prices might rise. For example, Disney stock went up by 10% in one day because the previous CEO named Bob decided to come back to the company as CEO. The last one I'll go through, although there's plenty of other reasons why stock prices can move, is investor emotions. Emotion is one of the biggest factors that can influence the prices in the stock market. And the two main emotions that we see in the stock market is either fear or greed. Currently, the stock market is very greedy and I've made over £10,000 on paper in the last month because of this. markets. When people become excited and optimistic about companies or the performance of the stock market, they tend to rush to buy stocks to try and push prices even higher. But when investors panic or even feel fearful, they tend to quickly sell stocks, and this causes prices to drop. That's why market prices can sometimes move really dramatically despite a company not changing at all. A common saying I quite like is that in the short term, the markets are moved by emotion, but in the long term, markets are moved by the fundamentals of companies. One of the most common questions I get when I tell people that I'm a long-term investor is investing a scam? Is it gambling? And I will debunk both of those things for you right now. When you think about investing and think of it as a scam, then you're probably thinking of something very different to long-term investing, which is day trading. If you've seen The Wolf of Wall Street or seen Forex traders flexing their Lambos in Dubai and think this is long-term investing, then you would be very wrong. Long-term investing is a lot less risky than day trading, although there is still some risk, as over a short period of time, the markets can fluctuate massively and people can lose a lot of money in a very short period of time, especially if people are borrowing money for leverage to try and make more profit on a stock. If that stock ends up moving the opposite way they thought it would, then they can lose so much money. If you invest in the long term, even with really steep short-term drops, you could be reassured that the market almost always goes back to the level it was eventually, and most of the time even higher. So having this long-term vision in mind allows you to think logically instead of emotionally when you see prices drop. With long-term investing, the aim is to invest through highs and lows consistently. That allows you to build up your wealth over a long period of time. It's assuming you've invested in reliable and strong fundamental companies and not just random meme stocks that you saw someone on TikTok promote. Lots of people also say to me, why do you invest in the stock market? Why don't you just put your money safely in a bank account where it can just grow over time? Because I'll be very transparent about it, there is risk in investing in the stock market, and your money would be a lot safer in a bank account. But I'm going to give you an example situation that will hopefully put into perspective what your money is actually doing when you put it in a bank account instead of investing it. So currently the Bank of England's interest rate is sat at 3.75%, meaning that high street banks also closely follow this number, and that is the interest rate they choose to allow you to borrow or save money. And inflation is currently sat at 3.3%. This means if you leave £1,000 for a year in a 3.75% bank account, that money will eventually go up to £1,037.50. But as inflation is 3.3%, meaning that your everyday items are going up in price by about 3.3% as well, despite your money growing in that year by £37.50, the real value of that money will only be £1,004.36, which is practically nothing. Pretty sure you can't even buy a meal deal with that these days. So what I'm trying to show you here in a very basic example is that if you're leaving your money in a low interest savings account, inflation is eating away at it. So despite me making a living off educating people about investing, I want to be very transparent and say that it isn't for everyone. So I want to share some pros and cons of investing and saving your money to help you decide which one is truly meant for you. So investing is more likely to give you a higher return over a long period of time, as the global stock market tends to give a return of about 10% historically, and that is so much better than your interest rate of 3%. But investing is considered riskier. And as I've previously mentioned, this is because the prices of stocks can go up and down, and if you choose to sell your stocks lower than what you bought them for, then yes, you can lose money. So saving your money is less risky, but you are more likely to get a lower return over the long term. With investing, on average, you are more likely to beat inflation in the long term, but sometimes your investments may not beat it at all. And that's why the emphasis on 10% average per year is important. Sometimes the stock market might go up by 20%, some years it might go down by 5%, such as during 2008 in the financial crisis, the stock market went down by nearly 40% in 1 year. But following this recession in 2009, the stock market bounced back and went up by 30%. So some years you might massively outperform inflation, but as I said, some years you might not. And that is why it's important to keep that long-term mindset and not panic sell when you see your investments go down in value, because as I said, historically, those prices are very likely to go back up again. Whereas saving your money in a bank account, you are almost always guaranteed to beat inflation, but this amount you'll be beaten it by is so minimal that, as I said, after inflation eats away at it, you're actually left with very minimal return. Another pro of investing is that it gives you the opportunity to diversify your financial assets. When investing in the stock market, you can choose to invest in stocks, bonds, ETF, commodities, and even more, whereas saving your money in a bank account limits that diversification. But the benefit of saving your money is that it is a lot less work mentally. Once you put that money in a bank account, you don't have to think about it whatsoever, but as I said, there is a lot of emotion and a lot of thinking when it comes to investing. So at its core, putting your money in the stock market over a long period of time can give you the potential to make a larger return. Either those investments go up by value, or you either receive more company profits through things such as dividends. Over years and decades, this growth could be significant and far more than what you'd earn from a savings account. But as I said, there is risk to invest in, and it does take a lot more work to understand. But if you're willing to put in that effort and learn the emotional intelligence of investing in the stock market, then it's definitely worth looking into. Am I saying that putting your money in a savings account is absolutely wrong and that all of my money is investments? No, that's absolutely not the case. I do have money in my savings account as well. As I said, that's for my emergency fund, for my short-term savings that I can easily dip in and out of, I do have the majority of my money in my investments. So what's the difference between saving and investing? Savings account is for short-term savings and investments is for long-term investments. So something that you may hear more mature investors saying is that they wish they had started investing earlier. And a lot of people don't realize the importance of having as much time in the market as possible. And honestly, time in the market is probably more important than how much money you actually initially start with. And that's because of the eighth wonder of the world, according to stock market legend Warren Buffett, which is compound interest. So compound interest means making a return on not only the money that you initially invested, but also making a return on any profits you've made on top of that. Over time, this creates a snowball effect where your money just keeps growing and growing faster and faster, because each year's gains create more gains for the next year. So what's more important than how much you actually start with is how consistent you are with investing. Of course, if you start with a larger amount, like potentially millionaires do, yes, they'll create a higher return. But starting with a little bit and building that up slowly is so much better than not starting at all. So I've mocked up a little graph with my friend ChatGPT to show you how this works in practice. So here I have an example of someone who starts investing at 18 years old and someone who starts at 30 years old. And to keep things simple, I'm going to assume that they invest £100 a month and earn a return of 8% every single year, which is very unrealistic, but to keep things simple, we've got to keep it like that. So by 65, the person who started investing at 18 years old would have nearly 400,000 more pounds than the person who started at 30, which is absolutely insane to me because person A, who started at 18, only actually put in 14,400 more pounds than person B. So if the reason you're not invested is because you think you don't have enough money and you'll just wait a bit of time to have more, this shows there's actually so much more benefit starting early, even if it's with a small amount, than waiting until you're older and invest in lots, because of the power of compound interest. There's actually more to gain from starting investing early than just the compound interest. So these are a few reasons why starting earlier might benefit you more in the future. The first one is that it gives you time to ride the ups and downs of the market. Inevitably, investments will go up and they will go down, but by investing in the long term, you can ride the waves of the market going up and down and remain objective and not panic sell every time you see your investments go down. Brings me to my next point. Investing early on gives you valuable experience and knowledge early on, and you'll learn so much more from actually investing in the stock market and seeing the market go up and down itself and learning to regulate your emotions than any YouTube video will. Learning lessons younger while your net worth is still relatively low will be invaluable for when you're older and your net worth is a lot higher, because you'll know what you're doing and you'll know how to grow that money without risking it. Investing at a young age completely changes your mindset to everyone around you who doesn't invest. Your urge to save and invest money over spending it on silly things will become so prominent that your spending habits will never be the same, especially against people your own age. And go back to the point of compound interest, you need less money to be able to achieve more. From an early age, that money starts to work for you, and investing the same amount of money in 10 years' time won't get you anywhere near as far, as we saw in the previous example on the graph. So there are actually two main different ways that people can make money from the stock market. So the first one is capital gains, which is a very posh word of just saying you've made a profit, and that's by buying an asset for lower than what you sell it for. The second way, and you've probably heard this word a lot, is making money through dividends. So some companies decide to share their profits with their investors as basically a thank you for investing in their company, and this payment is called a dividend. They usually get paid out to investors in regular intervals, either monthly, quarterly, or even yearly. Not all companies give out dividends to their shareholders, but a lot of people like to invest in companies who do in the later years of their life to make it a really passive form of income. So I listed off a range of different financial assets you could get in the stock market earlier, but I'm going to actually explain what each of them are. There is of course more than what I just list here, but to keep things simple, these are the main ones. The first one is of course a stock or a share, but hopefully you understand what that is from what I've been seeing in the video so far. If not, then I really need to do a better job. The next one is an ETF, and this is what everyone on social media always talks about when speaking about investing for beginners. So an ETF, or an exchange traded fund, is basically a basket of stocks that you could buy under one purchase rather than buying all those stocks individually. ETFs trade on the stock market like any other individual stock. The difference is if you buy this one ETF, you might actually be invested in hundreds, if not thousands, of different companies because of it. The most common example people reference is the S&P 500, which is an ETF that holds the top 500 performing companies in the US. So let's say you put £100 into the S&P 500, that £100 will be distributed across all those different 500 companies. The UK equivalent is the FTSE 100, which is the top 100 performing companies in the UK. There's more ETFs than just a country's economy. You can also invest in different commodity ETFs. You can also invest in different sectors such as green technology. So there's loads of different ones out there, so it's worth having a research to see what you're interested in investing in. Next is a bond, and a bond is essentially a piece of paper that says I owe you. When you buy a bond, you're essentially lending money to either the government or a business for a certain period of time. And in return, they pay you a fixed rate of interest, which is also known as a coupon. So bonds are a lot less volatile than obviously stocks are because you're given that fixed interest rate. They can be risky if you're investing in overseas bonds, as foreign exchange rates can impact your profits. Next is a REIT, which is a real estate investment trust, which allows you to invest in real estate without actually having to buy a property. These investment investments can have a high sensitivity to interest rate changes, and there's also sector-specific risk. The last one I'll go into is commodities, and these are the raw materials that basically run the world. First is hard commodities, which is things such as gold, oil, gas, copper, and also soft commodities, which are things like wheat, coffee, cattle, etc. Lots of people choose to invest in commodities as a way to diversify their investments, as most of them do tend to stay quite stable during economic troubles, such as gold. But as always, there is of course still risk. I've explained all the fundamental information that you should know. I wanted to go through some do's and don'ts from my own personal experience. Do research as much as you can. One of the very few things you can guarantee about the stock market is that you have absolutely no control over it. The only thing you do have control in is what you choose to invest in. And this means doing a lot of research to understand that what you invest in is fundamentally a good long-term investment and not a random stock you chose because some bloke on TikTok said that it was going to the moon. Of course, there is still the risk, even if you do all the research you could do, that company could still randomly fail. That is also why it's so important to diversify your assets. Some of the things you could research about the company is what does the company actually do? If you can't explain that to a 4-year-old, then you probably don't know enough about it to invest in it. Look at the financial reports. Is the company making profit? Do they have a heavy cash flow, or are they actually losing money? Are sales increasing? Are there any news of potential expansions in the company? Any mergers? Does the company have a competitive advantage above their competitors? Does the company have a strong brand reputation, or could it be ruined with one news story? All these different things that you could be researching to understand if the company is a good long-term investment or not. The next do is to make sure you build an emergency fund before you invest any money in the stock market. An emergency fund is a fund of money that you build up with about 3 to 6 months of living expenses in case of emergencies. And this is firstly because your money doesn't always immediately come out of the stock market when you sell an investment. As I said, a stock market is like a fruit market in a similar way is that they do have opening and closing times. They're usually closed on weekends and also evenings, but this can differ depending on whether you're investing in foreign markets or not because of the time difference. So if you need that money in an emergency, you're not always guaranteed to get that from the stock market. That's why you need that easily accessible fund to take money from. And secondly, you do not want to be in a situation where the market is red, stocks are currently down, and you're forced to sell your investments at a loss because you don't have that emergency fund to take money from. Next, you want to understand your personal budget and how much you can actually afford to invest. Some people might have a disposable income of £1,000 a month, some it might be only £50, but understanding how much of that disposable income you can use after you've paid all your bills and fixed assets, etc., will allow you to invest comfortably without worrying that you've invested too much and you can't actually afford to live the rest of the month. If you're stuck on how to budget or calculate this, then I'd recommend looking into the 50-30-20 rule, and hopefully that should give you a bit of guidance. And I would say once you use this budgeting template or this format, and next time you get paid you decide to use it, I'd always recommend investing and saving your money before you put that money away for fun spending. If you wait until the end of the month to invest your leftover money, you'll never hit the goals you want to, and you'll most likely end up overspending on that fun money and usually having little to actually invest with. So have a target of how much you want to invest every month, put that away as soon as you get paid after your bills and everything else is paid, and use that leftover money to budget for your fun money. And my last do is that if you're still apprehensive or unsure whether you actually want to put real money into the stock market, is to practice with a demo account. I used Trading212's demo account when I was first learning about investing, and it allows you to invest with fake money to basically see how the stock market works. It's a great way to learn about the stock market, how to buy and sell assets, but it also allows you to act objectively and not emotionally when you see that money go up and down because you don't have anything to lose because it's all fake money. And now we'll move on to some of the don'ts that I would recommend. Firstly, don't follow trends and just invest in things because of FOMO. Don't listen to random people boosting individual stocks online without doing that research yourself, because who knows, maybe they have actually done their own research and it is a really good stock, but you don't want to take that risk. Do not panic sell every time the market goes down. I know it is fearful seeing that money drop. I went down by nearly 10 grand in a few months on paper. I never once thought of selling. One of my favorite sayings is the price of long-term returns is short-term volatility. Basically meaning that if you have the guts to stay through when the market is being volatile and price is going down, that's when you're going to reap the prizes of long-term growth. Don't try and perfectly time the market. There is never a perfect time to start. Of course, if you start investing during a recession and prices are very low, then yes, you probably will make good growth. But recessions don't come around very often, so you cannot just wait for the next recession to start investing. You're better off being consistent with your investing and using an approach such as dollar cost averaging than trying to time the perfect opportunity to start investing. Even if you start at all-time highs, eventually that all-time high of today in 10 years time will actually be a very low price. So again, thinking long term. So I've waffled on about all this information, but I haven't actually told you how to physically invest in the stock market. Your first decision will need to be what platform you actually choose. So there's so many different types of platforms you can choose to use, but my personal favorite and the one I've been using since 19 and showing every single one of my investing videos is Trading212. Not only does it have zero commission investing, which means you don't have to pay a fee like other platforms anytime you buy or sell a stock, but it's also extremely easy to use and very beginner friendly. Even if you have no idea about investing, if you go on the app and just look around for a few minutes, you'll probably understand how to use it. And also, if you want up to £100 of free fractional shares when you sign up to Trading 212, you can use my code Gabby, or you can just go through my bio. I've also got a full Trading 212 tutorial on my page from like a couple weeks ago, so you can check that out if you want an in-depth tutorial of how to use it. And lastly, I'm going to walk through some very quick fire FAQs to hopefully round off some of the questions you may have following this video. First, how much do I need to start investing? Physically, you can actually start with as little as £1 on most platforms. Can I lose all my money? Yes. If you're silly with your investments and you just put all your money into one stock and don't do your research properly, then yes, you probably can. But that is the importance of diversifying your assets, not putting your money into risky companies, and doing as much research as you can beforehand to ensure that the company is fundamentally bound for long-term growth. How long should I invest for? Honestly, this is completely personal to everyone, but for me personally, I think a minimum of 5 years is good to allow you to ride the ups and downs of the market and also see that compound interest come into effect. What happens if stock market crashes? Stay calm. Markets usually recover. They have done historically. And if you sell your money during a crash, then that locks in your losses. But if you hold on to it, you've only actually lost money on paper until those stock prices start going up again. What's the best thing for a beginner to invest in? I get this question all the time, and I can't actually recommend individual investments, but I would always say to look at ETFs first, as they're simple, diversified, and focused on long-term growth. How do taxes work when investing? Now, because I'm from and living in the UK, I can only speak on behalf of UK residents. But if you are starting to invest in the stock market, I would highly suggest investing with a stocks ISA. As I said, I use mine with Trading 212. I actually have my cash ISA with Trading 212 as well. But stocks ISA allows you to invest up to £20,000 in the stock market a year, and any profits you make on that are completely tax-free. There was someone who ended up making like £1 million profit in 1 year, and that was completely tax-free because they invested through a stocks ISA. How often should I check my investments? Although I check mine pretty much every day during certain periods of time, if you are invested for the long term, you should only really be checking your accounts like monthly or even quarterly, because if you are checking that money frequently, it can lead to emotional decisions. So I hope you found that video helpful. I really hope it includes all the information that you need to know to get started without completely overwhelming you. I do have a free investing ebook in my bio that breaks all this information down even more and has pretty pictures and things. I also post lots of regular investing videos on my short form platform, so feel free to follow those if you want more regular updates. And yeah, thanks so much for watching. Please let me know of any questions, and I will see you in the next video.